There's $18 trillion sitting in US bank accounts right now. Yours is part of it. Here's the problem. Only about $3 trillion of that actually exists. The rest? It's a promise, a very fragile one. If you walked into your bank tomorrow and asked for all your money in cash, they'd give it to you, probably. But if everyone did that at the same time, the entire system would collapse in roughly 72 hours. Not because of corruption, not because of a conspiracy, but because of a design feature that's been hiding in plain sight for over a century. This isn't a hypothetical, it's happened before, and the math says it could happen again. Let's start with something simple. You deposit $1,000 into your bank. You check your account, it says $1,000. You assume that money is sitting there, waiting for you. It's not. Within hours, your bank has already lent out about $900 of it to someone else. A business buying equipment, a family buying a home, doesn't matter. The point is, your money is no longer yours. It's been turned into someone else's loan. But here's the strange part. Your account still shows $1,000. Their account now shows $900. The bank just created $900 out of thin air. That's not a glitch. That's fractional reserve banking, and it's the reason modern economies can grow. It's also the reason they can implode. The rule in the US is simple. Banks must keep 10% of deposits in reserve. That means for every $100 you deposit, they can lend out $90. The person who borrows that $90 deposits it somewhere else. That bank lends out $81. That gets deposited. Then $72.90 gets lent. Then $65.61. One deposit becomes $5, then $10, then $50. Your original $100 eventually supports over $1,000 in total money supply. Economists call this the money multiplier. It sounds efficient. It is efficient. Until everyone wants their money back at the same time. Because remember, the bank only kept $10 of your original $100. The rest is out there, circulating, built into loans that won't mature for 5, 10, 30 years. If you and 9 other people walk in at the same time and ask for your deposits in full, the math works. If 100 people show up, someone's going home empty-handed. And once word spreads that someone went home empty-handed, 1,000 people show up the next morning. This is called a bank run, and it doesn't require a crisis to start, just fear. Rational fear. The most famous example in modern history happened in 2007. Northern Rock, a British bank, had been lending aggressively, mortgages mostly. When the housing market started cracking, rumors began circulating that Northern Rock was overextended. On September 14th, customers started lining up. By the end of the day, they'd withdrawn over £1 billion. The next day, the lines were longer. The bank tried to calm people down. Didn't matter. Within a week, the UK government had to step in and nationalize the bank to stop the bleeding. Northern Rock wasn't even insolvent. It was just illiquid. It had assets, they just weren't cash. And in a bank run, only cash matters. Here's the uncomfortable part. Northern Rock was one bank in one country. What we're talking about now is what happens if this goes systemic, if the fear spreads, if it's not just one bank, but all of them. Let's imagine it. Day 1, a rumor starts. Doesn't matter what it is. A hack, a geopolitical shock, a viral TikTok claiming your bank is hiding losses. Whatever. By noon, a few thousand people have pulled their money. By evening, it's trending. By midnight, financial Twitter is in full panic. Day 2, branches open to lines around the block. ATMs run out of cash by 10 a.m. The bank's app crashes. Customer service is overwhelmed. Local news crews show up. That footage goes viral. Now, it's not just customers of that bank withdrawing. It's customers of every bank. Because if one bank can fail, why not yours? Day 3, the Federal Reserve makes an emergency statement. They promise liquidity. They promise your deposits are safe. But promises don't stop lines. The FDIC insures deposits up to $250,000. That's great if you have $250,000, but the FDIC's reserve fund has about $125 billion in it. Total insured deposits in the US, over $10 trillion. Do that math. The FDIC can cover roughly 1% of insured deposits in a full-scale meltdown. That's not a safety net, that's a psychological barrier. Now here's where it gets worse. Banks don't just hold your deposits and lend them out. They're interconnected. Bank A lends to Bank B. Bank B has assets tied up in Bank C. Bank C has exposure to Bank D. It's a web, and in a crisis, that web becomes a noose. In 2008, this almost happened. Lehman Brothers collapsed on a Monday. By Wednesday, every major bank in the world was quietly checking how much exposure they had to every other bank. Money market funds started breaking the buck. Commercial paper markets froze. ATMs in some countries were hours away from running dry. The only reason the system survived was because central banks opened the floodgates. The Federal Reserve, the ECB, the Bank of England, they all started lending directly to banks. Trillions of dollars created overnight, pumped into the system to keep it from seizing up. It worked, barely, but it revealed something important. The system is stable only as long as everyone believes it's stable. The moment that belief cracks, the whole thing runs on intervention, not fundamentals, intervention. So, what would really happen if everyone tried to withdraw at once? First, the panic would be faster than anything we've seen before. In 1929, it took weeks for bank runs to spread. In 2008, it took days. Today, with mobile banking and social media, it would take hours. Second, the banking system would freeze, not collapse, freeze. Withdrawals would be limited, maybe $500 a day, maybe less. You'd still have access to your account technically, but moving large sums would be restricted. They'd call it a temporary measure for stability. It wouldn't feel temporary. Third, the government would step in. Emergency powers, guarantees, stimulus. They'd flood the system with liquidity, just like 2008, but faster and bigger, because the alternative is breadlines and riots. But here's the part they won't say out loud. That liquidity doesn't come from thin air. It comes from future taxpayers, from inflation, from the slow erosion of purchasing power over the next decade. The system gets saved, but the currency takes the hit. Now, let's be clear. The odds of everyone trying to withdraw at once are low. Not because it's impossible, but because the system has safeguards specifically designed to prevent it. Circuit breakers, deposit insurance, emergency lending. These aren't accidents. They're features built after watching the system nearly die multiple times. But those safeguards all rely on one thing: trust. Trust that the government will step in. Trust that the central bank will print if needed. Trust that your neighbor won't panic before you do. And that's the loop. The system works because we believe it works. It's stable because we think it's stable. But the moment enough people stop believing, the math doesn't matter anymore. The reserves don't matter. The insurance doesn't matter. All that matters is the line at the bank. Here's the irony. The system is designed to never have enough cash on hand. That's not a flaw, it's the point. If banks had to keep 100% of deposits in reserve, they couldn't lend. If they couldn't lend, businesses couldn't grow. If businesses couldn't grow, the economy would stagnate. So we built a system that depends on leverage, on debt, on the assumption that not everyone will want their money at the same time. It's efficient, it's powerful, and it's fragile. Most of the time, that fragility is invisible. The system hums along. You swipe your card, the payment clears, everything feels solid, but underneath, it's balanced on a psychological razor's edge. Confidence is the only thing keeping it upright. There's a term for this in economics: coordination failure. It's when the rational choice for an individual becomes disastrous for the collective. If you think your bank might fail, the smart move is to pull your money. But if everyone makes that smart move, the bank does fail. Your rational fear creates the very outcome you feared. This isn't theoretical. In March 2023, Silicon Valley Bank collapsed in under 48 hours, not because of fraud, not because of a hack, because depositors lost confidence and pulled $42 billion in a single day. The bank had assets, they just couldn't convert them to cash fast enough. The FDIC stepped in. Depositors were made whole. The system held, barely. But it was a reminder that even in 2023, with all our technology and safeguards, a bank run still moves faster than the system can respond. So here's the question nobody wants to ask. What's the breaking point? Is it a cyber attack that takes down payment systems for 72 hours? Is it a sovereign debt crisis that makes people doubt government guarantees? Is it just a bad rumor that spreads faster than officials can contain it? Nobody knows, because the breaking point isn't technical, it's psychological, and psychology doesn't follow models. What we do know is this: every time the system is tested, the response gets bigger. In 2008, the Fed's balance sheet exploded from $800 billion to $4 trillion. During COVID, it ballooned to nearly $9 trillion. The next crisis, whatever it is, will require even more. And each time the same question lingers: if the system can only survive by creating trillions of dollars at a moment's notice, is it really stable? Or are we just buying time? Here's the uncomfortable truth: your money is safe until it isn't. The system works until it doesn't. And the transition between those two states can happen faster than you can react. That doesn't mean you should panic. Panic is the trigger, not the solution. But it does mean you should understand what you're participating in. This isn't a savings account in the traditional sense. It's a share in a collective illusion, a functional one, a necessary one, but an illusion nonetheless. The $18 trillion in bank accounts isn't sitting in a vault. It's moving, circulating, multiplying, creating growth and risk in equal measure. And as long as we all agree to keep playing, the game continues. But every so often, someone looks around and realizes we're all counting on everyone else to keep blinking. And that's when things get interesting.